All right, I want to welcome you all to our Tuesday expert interview. And so today I have the pleasure of interviewing Lamar Simpson. He's with Simpson Wealth Management, and he's going to give us some background on some investment tools as well as just approaches to financial planning. And so as you start looking at your overall approaches as things in life, there are several ways to consider that. And so Lamar's going to offer his expertise in those areas. And so Lamar, welcome, and thank you so much for being here.
Great. Thank you very much for having me, Arlene.
Absolutely. All right. So first off, I want to start off with some of the real basic things like I've heard stocks, I've heard bonds, I've heard mutual funds. What are they, and what's the differences, and what maybe is advantages, disadvantages in each of the different areas?
Okay, absolutely. So first of all, a stock is an ownership in a business. Okay, so when you're looking at the New York Stock Exchange, so people know these things when they see them on TV. When they hear the market was down, the market was up, they're referring to stocks, which are ownership of the company. So if you have ownership in a company, you're giving money to purchase something, and you're benefiting from the growth, or sometimes being in trouble if it goes down. That's how that works. That's an actual ownership where you have a piece of that. On the other side, you have bonds, which are their debt. So if you say, hey, I'm going to lend you, Arlene, so much money, $50,000, and you're gonna pay me a percentage of that for an amount of time. You're going to pay me interest, and at the end of that terms, if you have let's say a 5-year bond, you hand me $50,000. I'm going to pay you 5% for 5 years. At the end of that 5 years, I'm going to hand you back your $50,000. You don't own part of my company. I'm basically taking your money to improve my company and as a loan, and I'm paying this back to you. And there are certain protections that are in those bonds that are maybe a little better, or in some cases a little worse, depending on what the credit quality of those companies are. So those vary greatly, and we really want to keep an eye on those things, which is why you really need a professional to kind of walk you through before you just buy things. Now, a mutual fund can be made up of either of those things, or made up of both of them. So what a mutual fund really is, for lack of a better term, is a small company in and of itself. It has a board of directors. They decide. If you or I were on the board of directors of a mutual fund, we could say, hey, we really like Apple, we really like Comcast, we really like a couple of these things that we want to buy. So we'll buy shares in that company. They then take those investments, they pool them together to where you have a mutual fund, which could have up to 100 different holdings in it of different types in there. But at that point, all the decision making is all on that one company. Now, when we get to the advantages and disadvantages, in a mutual fund, if you're buying, it can be very advantageous, because if you buy a technology fund, let's say, technology is really a hot topic these days. Technology is something that is always benefiting from a lot of things, because people spend a lot of money on it regardless of how much money they have. So if you look at that and you say, okay, well, Apple's doing one thing, Samsung's doing another, Oracle's doing another. They're having this sort of battle. So if you and I decide to make a decision and say, okay, well, we're going to buy 100 shares of Apple. If Apple goes down, you're going to have 100% of that impact on your portfolio. If it goes down $10 a share, you lose $10 a share, regardless of what else happens in that industry. With a mutual fund, they're playing both sides of that. They say, okay, we'll buy some Apple, we'll buy some Samsung, we'll buy some Oracle. So if Apple has a problem and it goes down, part of that mutual fund may go down, but it may actually not go down at all as a whole, because you have 15, 20 other companies in there that would hold that buoyancy up to say, okay, well, Apple did poorly today, but the rest of our portfolio did great. That's kind of an advantage.
Okay, and so as you look at mutual funds, not all mutual funds are created equal, just like not all stocks or bonds are created equally as well. And so I know you talked about technology being one of those kinds of mutual funds. And, I know there's like international, a variety of different ones. But you also were talking about the board that's on for that mutual fund. And so is it important to understand the overall investment strategies of the board? Because can't you have different mutual fund classes even from the same company, where you've got different, that they have an overall strategy?
Hmm.
And so at that point, it's important to make sure that the overall strategy that of those different companies lines up with what you're comfortable with as well, right?
Exactly. This is kind of one of the jobs of the boards of directors on each mutual fund. So every mutual fund has a portfolio manager who says, "Hey, this is how I want to put this is how I want to put together my fund. I want to have a let's see, I want to have a large cap growth fund. So that means large companies that are all interested in growth. So those are major U.S. stock companies. So if you say this is my purpose, I want to be a large cap company. I want to make a certain amount of money. I want to have a certain amount of risk tolerance. I want to have, if a company performs too low or too large or too well, I want to get rid of it at this point. So that board of directors keeps that portfolio manager, who's essentially the CEO, keeps him accountable, saying, okay, well, you said your purpose was this, so now why are we holding a fund that is contrary to what our purpose is? And so you want to look at those things, and those things advisors can help you with. And you're right, if you look at a company, mutual fund companies tend to have, some of the larger ones have hundreds of mutual funds that do hundreds of different things. So you could have a technology fund, an international fund, an emerging fund, and there could be all different sides of these sort of things. So when you're sitting down and you're deciding, hey, what's my risk tolerance? What is it that I want to accomplish? What risk am I willing to take? And sitting down with somebody and deciding what that is, and then picking an allocation that works for you there is good. And it tends to be, for a smaller investor, more effective to use a mutual fund, just because we don't all have all the money in the world to go buy 100 shares of every single stock company that we want to own. And when we start getting into individual bonds, they're very expensive. Oftentimes you have to have a minimum of $50,000 to $60,000 to even purchase a bond on your own. So mutual funds are a cheaper way, a more efficient way of getting a lot of diversity and a lot of different things into the portfolio that can perform at different points in time.
Okay, and so you started mentioning a little bit of risk as
Mm-hmm.
well. And so, clearly that's a big part of financial planning overall. And I
Yes.
think that depending on what you're looking at your portfolio for, at different times, you maybe have different risk thresholds as well, right?
Yes.
And so then as a financial planner and financial advisor, that's part of what you're doing along the way is keeping track of your clients' risks,
Mm-hmm.
the things that are important to them, and then from there helping to guide them into the areas that are going to give them the best value.
Exactly. So and risk is ever present. Risk is one of those things, and no matter what we do, there is risk. You have people that will say, "Oh, well, I can put my money under my mattress. I don't have any risk then." Not true. It's not true, because if right now, if inflation goes up to 7, 8, 9, 10%, you just lost buying power, because you didn't have any interest on that, and your dollar became 50 cents in just a matter of time, right? You know, I've had the conversation where I'll talk to, especially say some people who are a little older, maybe a little closer to retirement. I'll say, okay, well, let's say we'll fast forward 10 years. All your stuff's paid for. You have no bills. Even your food's paid for. You have nothing to fear. You just have to buy one postage stamp. Every year you have to buy one. And I think it's, what is it, 49 cents for a stamp now?
I think
I
so.
believe
I
I
lose
think so.
track.
Yeah.
I buy the
The
forever
forever.
stamps, and so I
Yeah.
never have to worry about how much it is.
There you go. So if I would tell people, okay, well, you have to buy this stamp every year. Right now, a stamp's 49 cents. If I offered you an investment that gave you 49 cents a year, would you take it? Most people are nodding their head saying, well, yes, of course I'm going to take that, because I have that covered. Well, you really don't. You might have it for a while. When inflation starts to kick in, the stamp used to be 12 cents, used to be 2 cents. Now it's 49. In 20 years from now, will it be $1? And if you lose everything because your investment only pays you 49 cents, you've taken a risk. You've taken a risk that you can find some other way to cover your expenses. Obviously, there's things that are a lot more risky than others, a lot more volatile than others. And mostly what people fear, rather than the loss of money and rather than risk, is the loss of lifestyle, the loss of income. So we have to figure out, how do we continue a paycheck? How do we continue your lifestyle? How do we either make it the same or better? So this is why a lot of times when you see large market corrections and these things that happen and these panics, nothing ever good comes of panic. So if you kind of sit back, relax, especially if you have someone who is doing this stuff for you, they're providing the advice and they're telling you what to do when and what's working for you, you're going to make it past most of these things, because markets don't go up forever. They don't go down forever. They never will.
Yeah, absolutely. And so as you started talking about that, you started hinting a little bit about a financial advisor, and part of their job is helping you look at where you're at today and guide you. I know you talked about, the cost of your money sitting in the mattress, and
Hmm.
maybe that's, there's a house fire, or there's
Yes.
a robbery, and so you lost it all there. But the other side, you can easily say, okay, well, I'm just going to sit it in a savings account in a bank, and I'm going to earn 0.1% or 0.01%, right?
Hmm.
And so that's equally as disadvantageous
Yes.
as just putting it in your mattress, other than you do have FDIC
Yeah.
protection there. They're going to take care of the insurance side of that.
Hmm.
But let's shift a little bit into there's some different strategies when it comes to financial planning and financial advisors out there.
Hmm.
There are some who are going to charge you a percentage of a portfolio versus others who are going to charge you for a flat rate per year. And so I know you have one strategy yourself you've chosen. You apply that because you believe in that model. But
Hmm.
go ahead and talk a little bit about both of those, and maybe advantages and disadvantages.
Okay. So there are essentially there's kind of two different ways that you really manage a portfolio, or advisors will manage them. The first, which has been going up, but we're getting changes, because I don't know how many people know about the DOL and some of the different changes in legislation that have happened over the years. So we're even more tightly regulated than we were before. So the first way is that you come in, you bring whatever money that is that you want to invest, and we buy mutual funds. And we'll use an example of mutual funds here, because that's mostly where these things come in. If you buy a certain type of mutual fund, you're going to pay 5% of your money up front. So essentially 5% of your money is going to be in my pocket. And so the disadvantage there obviously is, hey, 5% of your money is gone. You brought me 100,000. I took 5,000 out. You now have 95,000, and you're hoping that I know what I'm doing with what I bought, right? So there's a disadvantage there because you lost that money up front. There's a disadvantage to a person who, like me, who's a planner, because now if I told you, hey, Arlene, I want to try and target an 8% rate of return on average, I've now taken 5% of your money. So your real rate of return, now I have to do a lot of work to recoup that 5%. And that aggregates over years. It's not just 5%. So that could cause a huge problem there for me. I think the advantageous part of it is you're not paying over the years. So you're not. So normally people charge a percentage. It's either yearly or monthly or quarterly, whatever way they choose. So you're not paying that every month. You're not paying that every year. You're kind of done. If you do have to change, however, you're paying a new 5% each time you change to a new fund. You're paying that upfront fee again. So that kind of erases it. In my mind, just in my personal opinion, there's not a lot of, there's a line you have to be at, how much money you have in your account before it becomes advantageous to pay a percentage as opposed to paying up front. And there's ways to get around paying up front too. There's different mutual funds that I use that, if the classes of them, if you use them and you have, let's say you only have $5,000, and it doesn't make any sense for me to buy 20 mutual funds with that. I'll probably buy a mutual fund, especially if you're not of retirement age and you're under 59, that I can just sit on. You're not going to pay anything unless you take that out early. You'll pay your 0.25% a year, whatever it is, and that's not even something that comes out of your pocket. That's something that comes out of the fund's pocket. So there's ways around that, and you can get that done. Now with a managed account, which is what I choose to use for, I have a certain dollar amount I want to be at to where that's advantageous for the client. You're essentially buying funds that are, all the loads are waived. You don't pay anything up front. You don't pay anything in the rears. You don't pay anything as we go in the fund. The fund is load waived. You do, however, pay a percentage. I charge my percentages quarterly. So quarterly, you're paying whatever percentage that we've agreed upon as advisor and client. The benefit of that to a client is that I can make as many trades as I want. I can trade 50 times a day. You're not ever going to pay that. I'm covering the fees on those, because I just think that's fair. Some people will charge you commissions on top of that. I don't think that's the way to do things. So it just doesn't appear right to me. So with me, you're not going to do that. So you say, okay, well, hey, I never pay a commission again. So he can trade. So I feel like, hey, You're going to do work. You're going to make sure that things are right. Because if people don't know you, they're not always going to look in this business and say you're going to be 100% honest. I know I trust you with my life. That doesn't happen overnight. That happens over years of the client's relationship, right? So the benefit of something like that is that you have all those changes. You have all those moves that are always happening for you without any cost. So I think the other thing is it's people look at it as, okay, if you have an account that you're managing for me and it's worth $200,000 and you make 1% of that every year, it behooves you to make that 400,000 because then you make 1% of 400,000. So people look at that as hey, we're both kind of doing this thing together. We both either gain or lose money. That's in this profession, you shouldn't be just striving to make an account bigger so you can get paid, but that is the way some clients will look, say, hey, well, the bigger thing you get paid on. So I believe that the managed allows for a better relationship. It allows for, another thing it allows for is discretion. So if you go out of town, you decide to take off and visit relatives in Houston or something, I don't know, and I'm watching your account and I say, gosh, I can't get a hold of Erlene. She's just having too much fun. As an advisor who has a managed account arrangement with you, I can have discretion to make changes that I need to make on your behalf if I know that must be done right now. Some of my clients say, you know what, don't ever call me for anything. That's what I pay you for. Leave me the heck alone. I don't know. Some of them will say, well, every once in a while, call me and tell me why you did something. What do you think? Just because they have some interest. I think it's sometimes it's nice to have a healthy amount of interest in your money. I think people don't have enough interest in what's happening. I even tell my clients, I'm like, I don't want you just to trust me and just never ask me about things, never come to your meetings, never do things. Understand what your finances are doing, why they're doing them, who's doing them for you, and why they're making the things that they're making. Make sure that plan is clear. So none of these things are advantageous to anybody if they don't understand what it is they're doing. If they don't take interest in their own financial growth over time. That's on the planning side, and that's on the investment side.
Yeah, absolutely. And that makes a ton of sense. And so really the key here and part of why we're having this conversation is I'm growing a community of a lot of younger individuals, some who are even, in high school age, college age, that are starting early on to learn. And I think one of the key important points that I heard you say is you should have an interest in what your money is doing. You want to make sure that you're finding an advisor that you have confidence in and that you establish the right kind of relationship where you've got good solid rapport, good communication, and it's really clear on what expectations are of the money and what you're going to do to help the money achieve the very best. And, I know based on conversations and things that, I've seen over the years of knowing you, your clients, it's their money, but it's also considerations beyond just the investments that they have. It's, and you went to bat for a client even yesterday because of some serious issues going on in her housing arrangement. And so that's in your case because of the way that you've established the relationship with your clients. You're looking at them as someone you're taking care of their finances, but that also frequently bleeds over into their overall life, right?
Absolutely. Well, you have to take care and serve the whole person. If as a financial planner or as a money manager, whatever it is that you do, that you don't care about the people behind your money, you'll be a failure. You won't do a good job. Everybody is a story. Everybody is a goal. Everybody's a dream, a hope, and it may not even maybe for them. It may be for their family. The particular lady you're talking about, she's lived a lot of her life. She's done very well, but she has people she wants to provide for when she leaves, and she's worked hard, so she deserves to have the things she needs while she's still living. There's a lot of things that go into the person, which is why I always compel people. Do I compel people to do planning just because I get paid? No. I mean, is it nice to get paid for the things you do? Yes. And you do have to charge people. I can't just give you free advice and charge somebody else because then I'm in violation. But the planning is in place because it allows for that extra level of relationship where I get to know everything about you, to where when I pull the trigger on that mutual fund trade or the stock trade, whatever it is, it's not just that number, this thing happening. It's like, okay, well, Erlene wants to do X, Y, and Z in 5 years. Is this going to make her reach that goal quicker or slower, or will she not reach the goal at all as a consequence of my actions? So yes, we do. People tell you when you do this for a living, you're self-employed, oh, it's great, you don't have a boss. You have 250 people that are essentially your boss, and that you're responsible for it. And again, you have people that say, oh, well, it must be nice to, make your own schedule and do these things. I'm like, well, yeah, do you want to come in and sit down and make decisions on people's lives every single day? Because it really is exactly that. And you should, if you don't take it that way, and if you don't have the advisor that takes it that way, don't have that person in your life, because if they care just about money, they're not going to be good at this business, just as in all businesses.
Absolutely. I totally agree. And, I think one of the other things that I know, having been around you for a number of years, is that you also have, you've worked around the police force. You're also very well informed when it comes to the state, any of the things going on within the state benefits and things of that nature. And so one of the other things that just a quick plug for you is also knowing that is an area that you have a lot of specialty in, is anything around state services, the law enforcement. I think you've worked with a number of nurses, and so you have some real awareness in those areas. But I think that's the other kind of leading to the other part of the question, is that there may be some people that have specialized needs that not every financial advisor, financial planner, money manager is as well suited to be able to deal with those. True. And so is that another thing that, is something that they need to look at, or how would they ferret out some of that information?
Well, I think it's very important. Now, some people in the area, especially in the Sacramento area, you're going to have a lot of people who probably have been through some pensions, because there's a lot of state workers in the city of Sacramento.
Right.
It's a hotbed. Probably not as many people have worked with law enforcement, nursing, some of those things. So you have to ask those sort of questions. Now, for me, myself, I have a menu of services. I have an ideal client profile that I use that talks about some things that I have experiences in the past. So it kind of gets some of those questions out of the way when in an initial meeting. Hey, do you know how to handle PERS? Do you handle FERS, STIRS, whatever those things might be? And people are going to know those acronyms if they work for those governments. They're going to say, okay, I need someone who will help me with this.
Right.
A lot of the thing with law enforcement is having a background in that I can maybe relate to people like that a little more. So part of the things that you have to look for in an advisor is not only what do you know, but do you know how to deal with me? Is there a personality thing where I can come in there? Because I could be the smartest guy on the planet, have every certification in the world, and if you don't like who I am, then we're not going to have a good time working together, and then you're not going to show up for your meetings, and you're essentially not going to ever reach your goals. So asking about designations is something. Licensing is something that you have to have licensing. I mean, and those things are pretty clear. Most of us are fiduciaries. That's a good question to ask if you do act as a fiduciary on behalf of your clients. If they don't, you probably do want to go the other way, just because there's a little less protection for your money there. And if you're not talking to somebody who's acting in that manner, you're probably going to have less good attention on your money, and good attention to the goals that you put forth to your advisor. So there's designations. I'm a CRPC. There's CRPC. There's CFP. Those sort of things are usually a pretty good sign the person has put a little extra time into their craft rather than just going to collect money. Most of us are insurance licensed, so we can talk about those things, so we can give advice on them. As you know, and being around me for a while, I don't choose to actually do insurance on my own. I like to refer that out, but knowing those things is good. If you're going to have a planner, you want to have a person that has knowledge of all the things you need in your retirement, and those things are usually pretty clear. Degrees, they can be helpful. Really, it's more of how are you perceived by your clients. I think you should always ask. Somebody asks for permission to give you, a referral source. If I have a client that will talk to you and say, hey, yes, I work with Lamar, and here's how I feel about him, whoever that person may be. That's a nice thing to ask, and most advisors will be ready with, 4 or 5 clients that don't mind having contact. They can't just give names out without asking. We have to ask each time, but having a reference point is a good thing to ask. Ask about cost. Come right out and ask, hey, is your cost higher or lower? What do you consider? My advice would never go with a person who charges too little, never go with a person that charges too much. If they charge too much, they think a little too highly of themselves. If they're charging too little, they don't think highly enough of themselves, so they're not going to do a good job for you. If you don't think you're worth it, then you probably shouldn't be doing it for a living. I'd say also beware of what I call barriers to your money. So the harder it is for you to get to your money because of what they've sold you, what they told you to get into, the further away you should be. Now, you look at an IRA, if you're young, you're probably not going to jump into, you'll be able to get into an IRA. There is a barrier there, not from us, but from the IRS. They're going to tell you,
Right.
you're going to pay penalties, you're going to do those sort of things. But anybody who's advising you to do certain things, anybody that cause you to not be able to touch your money in time, I would say if you don't see any changes, or at least communication. So especially in a managed account, if you say, hey, it's been 2 years and we've never changed even one of our funds, and some of them aren't performing, probably looking at somebody who's not managing your account. If things are doing well, let's say you have a good run, you go 2-3 years with some really good funds and they don't change them, at least a phone call. You should be receiving a phone call at least once a quarter from your advisor just to check up on you. It shouldn't be just, hey, I signed the paperwork, you got my money, now we don't talk. Discretion is a nice thing, but it doesn't take the place of communication and understanding your client. Just because I have discretion and I can change your account if I don't talk to you for a year, something can change in your circumstances and I have to know. It's not your job to call me and tell me that. It's nice if it happens and you let me know, but it's my job to keep up to date with you as well. And I think that's one of the biggest things in our industry that have kind of gone by the wayside, especially we're in this computer age. We're in this age where people like to talk on the phone with the text. They like to email. People don't communicate anymore. When we don't communicate, we lose that connection and we lose our effectiveness is what we're trying to do. I've lost you on audio, Arlene.
There you are. Okay.
There you go.
Thanks. Hey, yeah, and in that, what I heard was a couple things that I just want to focus on, and then I want to give people a chance to be able to reach out to you. Maybe you said something that catches their attention and says, hey, I'd like to learn a little bit more. But I think at the core, what you're talking about is that you've got a strong relationship with the person that is your financial planner, your money manager, whatever they are, whatever term they want to use, and that they know how to relate to you. If you go in and you've got someone who is very driven and very focused, and it's they're pushing you so hard, and you're saying, well, wait, time out, that's not my personality style, I'm not comfortable here, then that's a good time to run away. Or you've got kind of the other side, you've got someone who's very laid back, easygoing, and you're wanting to get more answers more quickly. Yep. Either of those are really good examples of probably extremes, but also to make the point that this is someone you need to establish a relationship with. So if you walk in the door, you have that initial meeting, and you don't walk away with a really good, solid feeling, not like they're your best friend, but you come away with confidence, then you probably aren't yet in the right place. And so it's a matter of finding the person that you're going to connect with, because it is a long-term commitment. It's a long-term relationship, and it should be anyway, not I'm walking in the door, next week we're done and we don't have anything to talk about. Yep. So, I think you've given my audience here a lot of different points. You've given some great insight into stocks, bonds, mutual funds, what they are and how to consider using them, as well as how to look at financial advisors and think about where you want to go for that relationship to help you manage your money the most effectively. And so if someone here says, oh, Hugh, you said a couple of these things, I've got further questions, or I'd really like to learn more about how you work specifically. Can you go ahead and share the best way for people to get a hold of you and be able to reach out to you?
Absolutely. So by phone, it's Simpson Wealth Planning. By phone, you can reach me at 916-333-5910. My email is lamar.simpson@lpl.com, and our website is simpsonwealthplanning.com.
Awesome.
So reach us by any of those ways. And the one final thing that I would leave your audience with is that before you even go into this thing where you're going to go invest and you're going to go do things, make sure that you don't have the debt like this and no money in the bank, and all of a sudden maybe you inherit $10,000, you get $5,000 from your return, and you say, hey, go straight to my local advisor and invest that money so I have an investment. Do not do this. Some of them will take. I've turned people like this away. The first thing we want to see is a good solid cash reserve, so that if anything goes wrong, you have money to pay for things that go wrong for you. And we want to see limiting of credit card debt. Because if you're paying, if I can only make you, if I do a great job and I can make you 12% for a year, and you're paying 24% on your credit cards, that's a lose. You're not doing anybody any favors then, and somebody's going to take your money and decide to take the commission. But I'm going to tell you up front right now, just don't do it. Go talk to somebody. Usually what I'll do is send you out with a couple pieces of free advice that you can take for the next year, and then if we can come back and rejoin after that, you're in a better place, then we do it. So that would be a final point. I think far too many people, our savings rate is so low. People need to start saving and stop going to debt.
Yeah, absolutely. And definitely my audience hears consistently to stay away from the consumer debt, the credit card debt and such. That is absolutely true. Debt is going to eat you alive. And so you make some excellent points there. So I appreciate that point as well. And, I know that long back I had always heard, don't invest something you're not able to lose. Not
Correct.
that that's your mission that you're going to, and not that you should go in expecting that you're going to lose. But if you can't afford to lose it, then you really need to evaluate whether investing is the correct action at that point.
Exactly.
And so, yeah, I appreciate that final point as well, Lamar. And definitely, I appreciate your time so much. Great insight for my audience here. And again, I'm going to have you one more time. Go ahead and get that contact information, your phone number, email, and your website.
Absolutely. So the phone number is 916-333-5910. Email is Lamar, Lamar, .Simpson, Simpson, at lpl.com. And our website is simpsonwealthplanning.com.
Excellent. Well, again, I appreciate you being here, and I will catch up with you soon. Thanks so much,
Great.
Lamar.
Thanks for having me.